Hi, good afternoon, everyone. I believe everyone has had a refill of their coffees, so we'll try to make it interesting for you guys. Uh, Vivek spoke a lot about the velocity of increased buyouts in the country, and the numbers are staggering. But one of the very important components to structure a successful buyout is financing, and that's what the panel will try to do today. We'll try to provide you a perspective from a sponsor lens, from an investor lens, from a lender lens, on how some of these trends have evolved over time. So maybe I'll just jump into a few themes that have emerged. And Piyush, maybe starting with you. The Indian markets have largely been an offshore heavy financing market. But some of that is changing now. But what are your views on how it has changed, whether it's the quantum, terms, emergence of new structures, unitranche, etc., all of that?
Hi, good afternoon, everyone. So, I think India is a fairly unique LBO market in that the structure in India has traditionally remained offshore, and the traditional LBO structures we see everywhere globally, where the bidco typically merges with the opco. That is not the case in 9 out of 10 LBOs in India, or probably 10 out of 10. The market has restricted itself to offshore structures historically, and for multiple reasons, I think, which are mainly regulatory. So we have, of course, historically we have had FEMA restrictions in the ease of merging the offshore bidco with the onshore opco. We have had regulatory considerations for sponsors to set up, when they set up onshore bidcos. We have had issues like ECBs, which are only accessible for slum sale, and there again there have been restrictions in terms of minimum tenor, maximum pricing, so on. FPI pools of liquidity again are narrow, restricted, they have withholding tax issues. So for all these reasons, the sponsors who look at buyout financing not just to fund a new deal, but equally important for them is the considerations in the subsequent years post the investment in terms of ease of refinancing, ease of amend, extend, dividend recaps, etc. Because interest rates, spreads move, businesses sometimes do better or worse than what is the original underwriting case, etc. So for all these reasons, the ease to and the flexibility to structure the financing, access the financing, and operate the financing post-investment are equally important considerations. So historically, for all these reasons, sponsors have borrowed offshore, stayed out of most of the regulatory issues that I mentioned earlier. It's been largely historically a bank dominated first lien type of market. Coming to your question about the trend, so I think we heard in the earlier presentation done by EY how sharp the growth has been, particularly in the last 5 years. So naturally, buyout financing and LBOs are now increasingly larger share of buyouts, which are increasingly a larger share of overall P investments. So we have seen the activity in terms of LBO market size also now sharply increasing. I think if I compare to 5-6 years back pre-COVID to now, it's almost like 4x at about $5 billion a year, give or take a couple of $100 million. So the market is increasing nicely. It's still obviously much smaller compared to global markets, particularly US, Europe. But having said that, it's come a long way in terms of its depth, width, and a little bit of product sophistication. Overall, while it still remains a bank-heavy market, but the ability to deal with larger deal sizes, I think from a depth point of view, the market has improved quite a bit. I think we have seen $1 billion plus deal sizes now getting done with reasonable amount of ease. Market doesn't break a sweat anymore, half a billion, 600, 700. We have seen multiple deals getting done through the year of that size. So that's one. The depth has definitely increased. In terms of breadth, I would say both in terms of sponsor width as well as breadth in terms of the participants in the syndication market. So in the earlier years, the market was more restricted to the top tier global buyout firms, let's say a dozen of them. Now we have seen Asian firms, we have seen Indian homegrown funds, we have seen infrastructure funds where structural subordination in the past has been a pretty sticky issue. We have seen secondaries funds as well accessing LBO markets. So width of sponsors who can access this market has definitely widened. Similarly, the width of the primary syndication market has also widened, though we still have CLOs are not really there. We have mostly Asian banks which are playing in this market, but definitely it has come a long way since we started back in 2013-14. Secondaries market is showing some green shoots of some trading activity. It's still very limited, but at least some early signs of activity are developing. In terms of products, we are now seeing unitranches, still far and few between for Indian LBOs, and there are multiple reasons for that. But in terms of pools of capital that can provide unitranches or MES or junior tranches or TLBs, I think that is not a constraint anymore. I think the issue is more about the fact that I think again in the earlier presentation we saw how good the track record in terms of exits and realized IRRs and growth rates that funds have achieved in India. And because of that, the sponsors, to my mind, don't have to top up leverage as much as in India, as much as they have to probably in more crowded markets like US. So the leverage levels have still been a lot more moderate here, and sponsors therefore can get that done in first lien market at lower prices. But having said that, I think we are seeing private credit funds now getting quite active in pitching unitranches and junior MES, as well. So yeah, I think we have come a long way, and overall quite positive on the market growth. It will, of course, as we've been hearing all day, overall, the private equity investment in India is only growing by leaps and bounds. We've heard the numbers, and we've also heard about how much dry powder is waiting to be deployed. Funds are becoming 2x of the earlier sizes and so on and so forth. So with all this crowding out in deployment, naturally, and valuations on the other hand becoming richer, leverage becomes a very integral part of sponsor decision making to remain competitive and at the same time meeting their deployment targets. So overall quite positive.
Thanks, Piyush. I think on the draft regulations, which are very talked about and hopefully a step in the right direction, will allow more participation onshore as well as allow banks to participate more. So maybe a question to you, Rahul. How do you think about regulations, views on it? How do you think that will help aid the market expansion?
Yeah, I think RBI has come out with draft guidelines, and probably it will get affected since April 1st of this year. It's a proposal to allow Indian banks to provide acquisition financing, and this is probably they have taken a very calibrated approach, but at the same time it's a defining moment because this is the first time you see Indian banking capital opened up for providing acquisitions. Why I say calibrated is because they have come out with a very detailed framework. It's allowed right now in a measured way to only listed companies, and it is very specific that it has to be applied only for strategic acquisitions. So it leaves out a lot of unlisted companies, which forms the bulk of acquisitions which Indian companies have been doing. At the same time, sponsor financing is still not permitted. Another thing is that they have provided various parameters. For example, listed companies can do these financings through banking capital, provided there is a 30% equity contribution by them, which means that obviously there is a measured way in which you can do leverage. At the same time, it is restricted to about 10% of the tier 1 capital available. So it doesn't really open up the floodgates, because tier 1 10% is about $3 billion of capital pool available. But what I would say is that this particularly means that RBI has now not kept a blind eye towards banks providing capital for acquisitions. I think as the banks perform through these financings for acquisitions, they will open up for more and more levers, and which becomes really interesting, because there, the Indian corporates typically, whenever they have been looking for acquisitions, both in India and abroad, I think they have been restrained by the sort of capital which they can infuse into, and they have been obviously, equity becomes the most expensive form of capital. That is why you see, outbound acquisitions being particularly ECBs are the routes which are used for financing, but that pool of capital is only available to very large corporates. This particularly means that domestic acquisitions by Indian corporates is kind of going to proliferate. 2 or 3 things which in the near term which will happen is, you will find that large conglomerates or large corporates which are listed in India, they will find it very easy to do tuck-in acquisitions, and that's where the pace of activity will really increase, because the leverage ratios etc. will not be so difficult for them to meet. The second thing is that a lot of these venture-backed capital for companies where they are looking for strategic exits. Earlier you had in India a lot of, and which is what you see, that most of the buyout funds have veered towards large-sized buyouts, and that's because typically people have seen that it's very difficult to get an exit for a mid-market company in the Indian ecosystem. That's going to change, because you will find that the large listed conglomerates will be more than willing to acquire these companies, given that the cost of capital for acquisition has reduced. One very important thing is that when all these conglomerates are looking for acquisitions, banks are only going to provide capital to the extent it is serviceable by cash flows, and they have a defined period in which they are going to provide capital with regular repayment schedules, etc. So I think there is a healthy mix of private credit and bank financing which will be available in the Indian markets. So it's a very interesting journey going forward. It will take its own course, it will take its own time. I just wish that banks don't make bad investments, and that really doesn't keep RBI in a very difficult evaluation mode. So all the best for the industry for this.
Thank you. Just taking cue from what you said and a question to everyone. We also saw in Vivek's presentation that tech and tech services was the largest sector where buyouts happened. But given what you mentioned, and that sector is obvious because free cash flow generation is high, you can upstream, and B2B clients, hopefully sticky revenue. But have you seen some of that change? Like, have you seen, and even Varun, from your perspective across different sectors, would healthcare see similar activities, industrial see similar activities outside of tech where the FCF generation predictability is very high?
Okay, so no, great question, Saakshi. And since we are at an IVCA event, I'm going to be slightly provocative. And I actually see the RBI measures as glass half full, right? The guys who have the greatest ability to use bank funding to sort of accelerate the buyout market or the institutionalization of businesses, right, have been completely locked out, right? At the end of the day, these services or these regulations, if and when they come into effect, right, they only cater to companies or large conglomerates who in any case had access to funding at fairly attractive prices, right? Look, I mean, I've got some large stalwarts of the industry sitting here. They will tell you that those guys never had a problem of financing acquisitions, right? I mean, which is why, since you mentioned tech services, just last month, we all know of at least one very, very large deal that got done, right? One listed player buying a large private player. I think, to me, the biggest challenge is that the sponsor ecosystem has been kept out. And it doesn't mean, I mean, and it just goes all the way from mid-market to the large end of the segment. So that's, maybe you can say, the first complaint I want to sort of make. And the second one is, you know, look, yes, you should logically see manufacturing, you should see healthcare sort of grow as far as buyouts are concerned. But again, I don't know if too many of the listed players are going to necessarily, you know, change their behavior. Second, and maybe there are enough people in this room who have clarity, I'm not sure about the tax deductibility of the interest. That has not been put down, right? So that just tells me that, okay, instead of going to Piyush, I'll be going to a bank, right? Otherwise, getting the, you know, credit from someone was always available. So net, and sorry if this sounds like the counter view, I actually just see the private credit market continuing to grow and innovate. And this almost seems like a bit of an afterthought. We'll see how this plays out. Sorry if this is not the popular view though.
Maybe I'll add a couple of points here. Look, I think unfortunately in the banking system, credit goes to the people who don't need it, right? And that's kind of how, you know, it happens. But my view is that as a regulator, I find it very happy situation that at least they've opened up the doors. And my view is that this is the first safest way which they wanted to test the waters with. A couple of years down the line, I think this will gradually open up. I wouldn't have seen RBI even look at this, you know, ability for banks, given what we saw in ILFS, where the whole, you know, asset liability mismatch was a really big concern for the regulator, to have opened up this avenue of financing for banks. But it's a very good measure. I see that opening up to sponsor financing in a couple of years.
We'll all pray for that, Rahul.
Yeah.
I think, you know, you look at it from a glass half full or a glass half empty, whichever way you want to think about it. But, you know, three things that we should recognize. One, you know, to everything that we are saying, the reason that all of us are sitting here as well, and the activity that has picked up, regulator has finally had to come and realize that time has now come for this level playing field to be not against the banking system. Now, whether you think that this has gone to a level where existing players are able to get that financing and therefore they don't need this, that's a point of view. But to me, the other thing that comes out of this is the legitimacy of how innovation will follow from here, in terms of, you know, some of the things that you've talked about. I don't even know whether the regulations still allow you to have an amortizing structure or non-amort. Can you know, what typically happens at LBOs, you have a back-ended, you know, amortization that will come into play or not. But it does move in the right direction, number one. Number two, there are other means in which some of the domestic acquisitions have happened through the capital markets route. Now, India doesn't have, you know, the mutual fund industry has been playing a very active role in some of the domestic, you know, acquisitions that have happened. I think the one fundamental thing that RBI is also seeing, and which to me is the biggest sign of how this industry moves forward, is the fact that not just financial sponsors, but the domestic India, corporate India, is now gearing up to a lot of buyouts. Some of the largest deals that have happened in the recent times have been on the domestic end of it. To me, that needed some additional engineering in terms of funding their capital needs. And this provides an opportunity. To the point that Rahul was saying, I also believe that this is complementary to a lot of work that the private credit funds do. Because there is going to be a template at the end of the day, whether it is, you know, driven by leverage, driven by cash flows, driven by, you know, what are the sort of guardrails the banks put because they want to be cautious. You will not solve for the entire cap structure when it comes to acquisition. So that's where, you know, there will be need for additional capital. So to me, that will also help bring about requirements that will sit complementary to this. So if you put all of that together, I think this is just acknowledging that we need to move forward. Now, in times to come, they may not happen over sort of a 1 year period, 2 year period, because we have not even seen a single bank draft the guideline or say that, probably I think SBI is going to take the lead in this and then everybody else follows. Yeah, time will tell, but I think it's an acknowledgement of the fact that this is an industry which is here to stay and grow.
No, makes sense, Rahul. And sort of taking cue on that, question to you on how do you think private credit has evolved over time? What are some of the innovative structures that private credit has adopted, and there is more openness to it in the sponsor community in solving certain cap structure needs? So any views on how that has evolved?
I think sponsors, given the activity in the sponsor industry overall, private credit has had to adapt and, solve for some of the requirements. Thankfully, so far, we have not gone, it's moving in that direction. We haven't come very covenant-light structures, though, the global standards are almost reaching there in terms of, where things are. But in terms of innovation, I think there are transactions, and I think Piyush touched upon it, very few where some of the domestic requirements, some of the domestic capital is coming into play in financing, not conducive given the regulatory constraints that sit with it. But, I talked about the mutual fund industry, which in my view is a proxy to some form of private credit funding where, instead of doing pure share back, disclosed, you have lockbox structures, or you have, somewhere, again, there was a talk about acquiring entity BidCo merging with the OpCo. Those structures have also become a bit more innovative. FOCC guidelines restricted that till some point of time. So to me, there are already innovations that are in place within the constraints of what is there. My view is that with this, the second step is going to be to allow a lot more of the so-called regulatory restrictions becoming eased out, is the way I see it.
Yeah, I think private credit is already stepping up in the sponsor space. While, as I mentioned earlier, it's still very senior first lien heavy market, but we're increasingly seeing now occurrences of unitranches or full pick, structures, or junior mezz tranches, TLBs, etc. I think we have seen in US how the bank market went into a seizure back in 21, 22, and private credit took over, and now they're both, banks are back and private credit is still there, and they're both jostling for space. So I think private credit definitely has a role to play, and I think we have very healthy appetite amongst private credit pools of capital. I think when it comes to sponsor, just going back to Varun's point, I think while the acquisition framework is being relaxed, but I think the overarching restrictions on foreign owned and controlled companies to access domestic debt capital for funding acquisitions by way of acquiring shares, I think that would continue. So I think while the relaxation will help the domestic strategics who, AAA, AA anyway would have accessed the corporate bond market, but maybe that would extend further. But I think when it comes to sponsors who are all, even our domestic, major funds are all having global LPs and domiciled in Mauritius, Singapore, Gift City, etc. So I think they would continue to have this restriction for the time being. But yeah, ECB framework is also being relaxed, or at least, the draft paper is out, and that actually is, some of those relaxations are pretty transformational, I think, in the longest time that we have seen. So far, every year it's been, policy changes have been more tinkering at the margins, but this time we are seeing some very fundamental changes, and that should help at least where the deals are structured or can be structured in a form of slump sale subject to stamp duty and other tax considerations, etc.
I'll just add a point here. So look, over the last 6 years or so, we have deployed $3 billion in credit, and of which, I was just doing some math, about 700 million is what we have deployed in acquisition financing. So my view is that, over the next 5 to 7 years, private credit will still do a lot of heavy lifting in terms of providing bespoke capital for buyouts and acquisition financing, and that primarily is because of the customized, flexible, bespoke solutions which each of these transactions want.
I'm going to take the liberty again to ask a provocative question to the panel. But we've seen a lot of money flow to India, whether it's buyout, minority, and it's become a destination of choice for a lot of global funds, for Indian GPs. Do you think financing, whether it's innovation, whether it's regulation, whether it's lender appetite, has fully kept track of the massive influx of money that has happened? I think we discussed the regulation in detail, but mezzanine as a product still probably doesn't exist or is not fully viable. And of course, there is an angle of maturity of businesses in the country that one has to keep in mind. But has, in your view, with, I think we read 60 billion in the last presentation, that's huge. So what is the view on that of the panel?
Let me become controversial here, and to Varun's point. I actually think innovation in its truest sense of what some of the most efficient structures are, probably you are right, hasn't happened. But part of the reason for that is that we've had every and any lender find ways, because of restrictions, to try and be part of that ecosystem to finance that. And you've had, in some ways, misaligned structures, coming into the sort of COVID era. Pre that, we've seen some, cleanup that happened. So to me, the reason why innovation has not happened in the truest sense is more because you've had, I use this term that in India there is no bank market or a high yield market. You have a continuum. You have a lender who can come at 8% till 20. You will find every half a basis point you will have a lender. Now in that environment, innovation is already happening, because you have in infra, banks can fund some part of the equity. So structurally, money has been available. It's just that it's not been the right lender to the right borrower requirement. And that's what has prevented. And today, as you talk about private credit, people ask, why should, this is mispriced, this is low, this is high, will you get a deal? Which is again coming from that vantage point. So I actually think innovation is happening. I mean, people are deploying money. Everybody has said here that, there are lots of deals happening. And India is the favored market for deploying money, because that's where influx is happening and there is growth happening. So I actually don't think the word innovation is not happening in India. It's just not happening in the most efficient form, I would say.
Yeah, I would just add a couple of points to that. So I think we are all aware that India needs to solve for some massive amount of debt capital needs over the coming years. I think infrastructure build out, private investment as and when it properly picks up. And a lot of it will not be solved by domestic capital. So I think clearly access to international capital, across capital structure, bank capital, project finance, debt capital, mezzanine, acquisition financing, all of that. Also debt capital markets. So I think historically regulators have had proper checks and balances through ECBs, FPIs, all forms of access. We are seeing some of that getting relaxed as we speak. To my mind, there's more that probably needs to be seen over the years, over the coming periods to facilitate more foreign debt capital to come into India. And I think also on the tax side, we saw the concessionary withholding tax not getting extended, both on ECBs and FPI. So some of those things need to, be smoothened out. There's enough and plenty of international debt capital, which of course it's subject to always risk-reward equation. So I think when they see relative value in India, and hopefully as US rates come off, they'll see more of it in Indian type of credit. To my mind, there's enough and more capital available to come into India if we have the right access available.
Yeah. Just to sort of reiterate what Rahul said, right? I think there is enough and more that happens within the constraints that private credit operates in. I don't think within what they're permitted to do, there is no shortage of innovation or flexibility. I think the challenge is that the structure does not allow for efficiency, which is why, despite us being at the growth rate we are at as an economy, inflation being where it is, you just don't see, leverage or acquisition financing becoming, more efficient. But that's because of the structures that we have, whether it is security packages or, governance and all of those things. But that's topic for another day, I guess.
Yeah, no, hopefully I think it moves in the right
I'll
direction.
say, a word of caution here that, RBI in my mind has opened up these gates only a little bit, but that also is on the back of, if you see, all the corporate industry has significantly delevered itself over the last 4-5 years. So the leverage ratios are under control. And the second is, if you see from the banking system, the NPA levels have also come significantly under control. If we see that those two things again going out of control, maybe we'll see, again closing of the gates over here. So, it's
Not
a fine
very
balance.
happy prognosis, but sure. Varun, switching on a little bit from a sponsor lens, right? How do you think about leverage when you think about your portfolio, and how do you see that different for a portfolio in India versus what you may have seen, with Investcorp outside India?
So, Saakshi, great question. Just for reference, globally we only do mid-market buyouts. It's in India that we have a mixture or a combination of mid-market buyouts as well as minority investments, right? Look, when it comes to structuring the financing or, acquiring acquisition leverage, the frameworks are very different. See, I think when you're looking at Western Europe or you're looking at North America, it's a very well-established playbook, right? Look, everyone knows by sector what kind of underwriting is going to happen as far as credit is concerned, right? Where is it going to be asset-based? Where is it going to be cash flow-based, right? People know how the security package has to be created. People know, how the operating playbook has to be structured. For example, what the lenders are going to ask for, what KPIs, how should the monitoring happen, and all that. So I think it's almost like, our capital markets teams in North America literally are great at running a process, because I think a lot of it is just identified, right? I think when it comes to India, and honestly our experience has been more about, taking an Indian asset and having it acquire something overseas, or at least the acquisition we've done is we've kind of kept the holdco unlevered and put all the leverage on the opco, because that was the easier thing to do. At the stage we are at, it's a lot more bespoke and a lot more case by case, right? Where you have to see, okay, if this is the asset, what can you do? I mean, can you put more debt on the cash flow, or do you leave it unlevered so that when you have to acquire something, you will do that? So unless, the experience is different, but for us, it's always been every situation, in India presents a unique financing argument, right? So all of those things, whether it is NCDs or you go to the markets or do that, there is something for which hopefully we will be talking soon. But then again, it's it'll be like, let's look at this and please tell us what can you do with this, right? That kind of situation. Honestly, no set answer.
But you're right. I think, that is also one of the challenges for Indian markets to scale up, because every transaction is bespoke. It takes its own time to, consummate, because you have to tweak here and there. You can't scale up with customization on every transaction, which, we need to learn from.
So I've been indicated to move off stage in 5 minutes, so I'm just going to ask one final question. Just what are some of the learnings with respect to financing within the Indian context, largely buyout related, that each of you would like to reflect on, that this is not a trajectory that the country or, in sort of the firm's journey should have been taken? And as you think about outlook for future, what is to be desired, would love to have everyone's view on it.
So in terms of outlook, I think we have kind of, as mentioned earlier, overall, I think the secular direction looks quite positive. Enough and more pools of capital available both internationally, and we are seeing some easing of regulations onshore as well. There's probably more access, as I made earlier. I think we need to have a little bit more robust credit derivatives market as well. Our securitization market also is fairly underevolved at this point. So there are a few areas overall, in the broader debt capital markets arena where I think there's more innovation we need to see. Yeah.
And just to add to that, the broader regulatory environment in terms of taxation, in terms of just treatment of various instruments, and also the whole IBC framework. I know this is not the right forum, but just seeing a unidirectional trend that no reversal happened. I think I just add those 2 points, which really will make this more robust, because you need an environment where you don't have to second guess a structural nuance once you finance something.
See, the way I see it, I think sponsors have tasted early success on buyouts in India. So the market is going to really take up from here. Corporates are very positive given their successes in acquisitions. So there is a lot of activity just going to happen. From a availability of pools, you have some of the private credit funds in the last 5 years who have really provided exits and healthy returns. So I see foreign pools of capital increasingly deploying capital in India. At the same time, through the AIF structure, you have the domestic pools of HNIs, etc., which are being tapped on by the smaller mid-market credit funds. So both from the demand and supply, I see a rising traction here.
No, I disagree wholeheartedly with Rahul for a change. No, I think, look, for financial sponsors, buyouts are now becoming increasingly important. It's no longer 10-20% of a strategy. Maybe it's much higher, 70-80%. I think with that, need for financing expertise is only going to grow. And I think on the supply side, you are seeing a lot of innovation come through, right? I mean, rarely, and I'm sure, Saakshi, that's your experience at Kedaara too, rarely do you have a conversation where you go to one of the large lenders and say, we need to get this done, and they say, oh, this cannot be done, right? I mean, there's always something or the other that comes through. So I think the market's in a great place right now.
Great. Well, thank you everyone for sparing the time, and thanks to the lovely audience.